Get Rich Education is brought to you by Ridge Lending Group, Apartment Investor Mastery, and Producers Wealth.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Hey, you're inside GRE, episode 186. From Auckland, New Zealand to Oakland, California, and across 188 nations worldwide, this is Get Rich Education. I'm Keith Weinhold. Rich Dad Tax Advisor Tom Wheelwright is back with us today, and I think you're going to find it to be the best chat Tom and I have ever had, and perhaps even the most valuable learning you've even had from Tom here. But first, here's a specific little-known way to build your wealth with income property and taxes. And now this is a really interesting thing for real estate investors. It's called the Masters Rule. Now, a few weeks ago, the Masters Golf Tournament in Augusta, Georgia wrapped up, and the name of this tax rule that's very favorable for you came about from residents of Augusta, Georgia, renting out their homes to Masters Tournament spectators and even renting them out to the pro golfers themselves sometimes. In fact, I have a close friend that lives near Tacoma, Washington, and he and his family of four take advantage of the Masters law almost annually with a major golf tournament near their home there. They rent out their home for $3,000 to $5,000 per week for up to 2 weeks to golf tournament players or spectators. And then during that week, they go off to vacation in Maui. They see it as the golfers basically paid for their great family vacation. And here's the tax angle on this. The whole thing is a 100% tax-free event. Okay, so the IRS says what you can do is rent your home or your second home tax-free for up to 14 days per year. And that works perhaps nowhere else better than with the Augusta houses that Masters participants or fans want to stay in during the Masters tournament. Those houses really rent for big bucks. Now, there is no dollar limit to how much income you can get this way tax-free. There's just the 14-day limit. So if you have such a property near any event, if you live near any event that's shorter than 15 days, not just golf, any event from a tennis tournament to auto racing to the World Series to the Super Bowl, whatever, you ought to consider this as a nice income supplement for yourself. Now, would you go out and buy a house solely for this purpose? I mean, no way. That would not make sense. Don't let the tax tail wag the dog, right? Now, that would not work with a property that you own specifically like for Airbnbs. You have to use the property as a personal residence or a second home, not a specific investment property. So in short, if you rent your home for less than 15 days during the year, any rent you receive is totally tax-free cash. That law is called the Masters Law. Pretty nice. Well, hey, you know what I was just thinking? It's pretty interesting how over the last few weeks, you and I have discussed real estate investing on both the macro and the micro scale. We talked about Dreamy Belize with world-class developer David Keener. Then we even went bigger picture as Richard Duncan was here, and he told us how moves at the Federal Reserve and even moves at the European Central Bank affect interest rate movements for your future mortgages. And then on the micro scale, I talked to you about real estate photography and enhancing your rental property's curb appeal, from simple things like a freshly painted door to just trimming the bushes. And then last week, we discussed income property in Jacksonville, Florida, and just what makes a good turnkey provider that's not trying to bilk management leasing fees out of you. And I was just thinking how amazing it is that real estate investing spans this super wide swath from the big picture to the small picture. Hey, well, let's meet in person in Placencia, Belize, like we talked about a few weeks ago. You've heard me on the show here for years, so let's turn that around and let me be the listener. Come on along, enjoy a super nice place, and tell me your thoughts and your challenges and your big wins. And Why Placencia, Belize? Well, it starts with astoundingly underpriced real estate. Diving, snorkeling, sea fishing, sunbathing, beach combing, jungle trekking, cave tubing, wildlife from jaguars to scarlet macaws, Mayan ruins, and an opportunity to buy real estate at prices like you would have been able to buy at in Hawaii back in the 1950s before Hawaii had its massive real estate run-up. And when you're there in Placencia, you're going to feel like you've entered a time machine and gone back in time. And I've traveled extensively in Hawaii, Oahu, the Big Island, Maui, Kauai, and in Belize, the water is warmer than Hawaii, and it's closer to most of the U.S. than Hawaii, besides having astonishingly low prices comparatively. So from mainland condos to private islands, all with a world-class builder, you can invest for both cash flow and lifestyle at the same time and in a turnkey fashion. And this is all in a stable English-speaking nation close to the U.S. with government officials supportive of development and Belizean currency pegged fixed at 2-to-1 to the U.S. dollar. It really is an amazing confluence of circumstances, and that's why I'm happy to tell you that I'm going back to Placencia not just once, but 2 more times this summer. So meet me there on an investor tour. I'll be there for the one July 20th to 23rd, which looks like it's already sold out. And then I'll be returning to Placencia again for the September 6th to 9th investor tour, and groups are limited to 20 people. So we're really going to get to hang out together, and you'll get to know me better. And with such a limited tour group size, you might even get to know me well enough to get tired of me. Who knows? The 4-day and 3-night tour includes your 30-minute round-trip flight from Belize City down to Placencia, meals, transportation, taking a boat out to private Belizean islands. Man, so what is your return on life? If you want to meet there, get started at getricheducation.com/Belize. Getricheducation.com/Belize. Robert Sislo, if you would please provide a summary of what we do here at GRE in less than 45 seconds. I'll meet you right back here with Rich Dad Advisor Tom Wheelwright.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit getricheducation.com.
Today, we have a flat-out tax genius on the show. He is the founder of Wealthability. Donald Trump selected him to contribute to his Wealth Builders program, calling him the best of the best. He's the best-selling author of the book, Tax-Free Wealth. Recently, he and Robert Kiyosaki co-authored the book, Why the Rich Are Getting Richer, and he and I are each contributing writers to the Rich Dad Advisors blog. We write articles alongside each other there at richdadadvisors.com. Welcome back again to Get Rich Education, Rich Dad Tax Advisor, Tom Wheelwright.
Thanks, Keith. Always great to be on your show.
Yeah, we are on the show together again. You know, if we have you on the show much more often, which we very well may because people love hearing from you, I might soon call you the co-host of Get Rich Education. So
that would be the worst thing I've been called, let me tell you.
Okay. Well, you know, Tom, we have something really interesting here at Get Rich Education that I seem to talk about fairly regularly, and that is, where does one's return actually come from when they're a real estate investor? I sort of call it the 5 facets of real estate investing, the 5 profit centers that you simultaneously have when you buy a cash flowing property. And I want to ask you, as I go through these, just to kind of estimate how much annual ROI benefit one gets from the tax advantages on a property when there's this scenario? So it's kind of a nuanced question, but I really think it's going to help us and our listeners understand where all your profit contributions come from with the 5 ways that you're paid as a real estate investor. So when you buy a $100,000 property, say a turnkey single-family home, you put a 20% down payment on a $100,000 property, and you have a 5% mortgage interest rate. Well, here's how your return might look in year 1 with the 5 ways that you're paid. First, you might have leverage appreciation. Your $100,000 property might go up in value to $106K. Well, that's a $6,000 gain on just $20K of skin in the game, and you're starting to feel the magic of leverage. That's a 30% return. The second way you're paid is if you have just a thin cash flow on that property, just say a $100 monthly cash flow. Well, that's $1,200 annually of cash flow on your $20K of skin in the game, and that's another 6% return on top of your 30% leverage appreciation. The third way you're paid is you might have $1,000 of tenant-made principal pay down on your $20K. That's another 5% return. And say you also get a 4% kind of phantom return on the inflation hedging benefit when you're going ahead and tying up long-term fixed interest rate debt. So you've got 30 from the leverage appreciation, 6 from the cash flow and the cash-on-cash return, another 5% return from the principal pay down, 4% from the inflation hedging on that loan. My question is, what is the tax benefit that you get here in year 1? I know there's some variables there. I know you're estimating, for example, for one thing, you're going to have depreciation in that first year. You also have a $6,000 capital gain that isn't going to be taxed if you roll it ahead and do a 1031. Can you estimate the tax benefit gain that you get in this scenario that I just gave you?
It's about 40% of your return. If your return's 40%, add another 16%. That's about where it's going to turn out. And the reason is really fundamentally because of depreciation. Because what's going on is just like you got appreciation on the entire $100,000, and that $6,000 appreciation did not go to the bank. It went to you 100%. Right. The bank put in $80,000, but they're only getting back their interest rate. They're not getting back that appreciation. Okay. So all of the gains go to you. The same thing is true with taxes. You don't get a depreciation on your $20,000. You get depreciation on the $100,000. And under the new tax legislation, what Trump and the Republicans enacted in 2017, there's huge tax benefits the first year. In fact, of that $100,000, my estimate is you probably, the very first year, probably be able to deduct about $25,000 right off the bat. So, $25,000 at a 40% rate, that's $10,000. So that's a 50% rate. Actually, I was wrong. It almost doubles your return, okay, in that first year. After that, it's not going to be as high, but on average, over the first 5 years you hold that property, you're going to average about a 40% increase in your return just from the taxes, whatever that return is. If your return is 10%, I would add 40%. But the reality is that it's always going to be much more than that. If you leverage, again, you need to leverage that. That leverage is so important because otherwise you only get $20,000 worth of deductions over the life of the property instead of $100,000 of deductions.
Sure, if you don't have the leverage, you don't have the 30% return. You would just have a straight 6% gain on the appreciation, and then you wouldn't have any inflation hedging benefit from tying up the long-term fixed interest rate debt either. But let's just drop back for a moment. I mean, I am just a bit fascinated with and enamored that the return is that high. So if you look at the first 4 ways you're paid that I stated there, Tom, with the leverage appreciation, the cash-on-cash return, the tenant-made principal pay down, and the inflation hedging, that total is 45% in the example that I gave you. So another maybe 40% of that number in year 1, which would be another 18%?
I will tell you, in year 1, you may be as high as another $10,000, which is another 50% return on your investment. It's not 40% of your return. It's actually another 50% return. So you take that 37 whatever percent you came up with and you add another 50%, you're actually up to about an 85 to 90% return your very first year.
That is just astounding. And, I was conservatively estimating just another 2% is a number that I had thrown in there, knowing I'm being very conservative, including maybe if one didn't do a 1031 down the road and all those sorts of things. So
I'm not even talking about 1031. Yeah. I'm just talking about the depreciation. The reality is that, of course, if you're in a lower tax bracket, it's less of an impact, right? here's what happens. Under the new tax bill, under the new tax law, let's say you do a cost segregation. We've talked about that in prior shows.
Yeah.
Let's say you do a cost segregation, and let's say that out of that 100,000, 20,000 is equipment and electrical and furnishings, everything else, okay, cabinetry, et cetera. Well, that now, under the new tax law, is fully deductible in the year you buy the home. So instead of depreciating that $4,000 a year over 5 years or $3,000 a year over 7 years, you get to take the entire depreciation in the first year. It's called bonus depreciation. So that's a huge benefit that first year. On top of that, you're still going to get depreciation on the rest of the house. So that's why I say depreciation is such a huge benefit, because that depreciation, that $25,000, is effectively worth $25,000 times your tax rate. And you have to include your state and your federal tax rate. So it's both tax rates. So 40% is not that hard to get to. 30% is not that hard to get to. I mean, let's say we're in a 30% tax bracket. 30% of $25,000 is still $7,500 on a $20,000 investment. That's an additional 37.5% return. So what I've found over the years, and I've run all these numbers like you do, okay? I've run them for years and years and years. And the number one way to increase the return on your investment is taxes. You have to combine it with leverage. But if you're not doing any of the things you're supposed to do from a tax standpoint, if you're not doing the tax planning, if you're not dealing with the passive loss rules, if you're not dealing with the like-kind exchange, if you're not dealing with those rules, then you're losing that benefit, or you're postponing it for a very long time. So that's why we always talk about how having that tax advisor is so important. Somebody who understands real estate, understands the tax law, understands the new tax law, because it's that advisor that's going to actually help you increase that return that much. And there's no way you can know all the details. I mean, it's like me knowing all the details of how to build a house. I'm not going to know that. But I can have a great general contractor who knows everything about building a house. And then all I have to do is I need to work with that general contractor. I need to make sure he knows what I want. He needs to know how I want to work with him. He needs to know, what's important to me. Same thing. When you're working with your tax advisor, you have to have those conversations. And the more conversations you have, the more success you're going to have in taking advantage of these amazing tax benefits.
Yeah, I'm just still astounded at the impact of the depreciation on that example that I gave you. That's really great news. And I think you're touching on it, Tom, but what I like to think is $1 of tax savings to you, the real estate investor, is actually worth more than $1 of tax savings to a mutual fund investor over here, because as real estate investors, we know how to go ahead and reinvest that dollar and get leverage and all these other benefits that the mutual fund investor doesn't.
Well, yeah, think about this. Let's say you got the $10,000. Okay, let's just take that $10,000. Couldn't you buy another property for $10,000? Yeah, because you go borrow $40,000. There's plenty of properties in the U.S. that are under $50,000 still, and you can go buy another property. And so basically what you've done is the government's given you your real estate. It's like giving you a new property. The reinvestment potential is absolutely astounding. I've run these numbers. Over 7 years, a single $100,000 investment, you can easily turn that into several $1 million over 7 years. It's that big of a number.
That's right. And these return numbers, they are pretty astounding. So just a reminder that, Tom told us reasons that, well, in year 2 and year 3 and year 4, some of them are still going to be there, but their impact is going to be minimized. And then additionally, in an environment where you have a property that appreciates, of course, your leverage ratio is going to get cut down if you don't prudently harvest that equity and increase your velocity of money, and your inflation hedging benefit begins to go down as well as more of that long-term fixed interest rate debt gets retired. So this return does erode, but we're starting at a pretty good high place here that most investments just don't start off. Well, Tom, we talked about depreciation a fair bit, and in Trump's Tax Cuts and Jobs Act, he tweaked residential depreciation a bit. Can you give us an example, a pretty simple example of depreciation, and actually put some numbers to it?
Yeah, so let's take your $100,000. And so of that $100,000, you have to start by breaking it down as to what did you really buy when you bought that property?
Land and improved property.
You bought land. Okay, that's one thing you bought, which doesn't get a depreciation deduction because, like I always tease the IRS, and even the IRS understands that land doesn't wear out.
Even they know that.
Even they know that. And typically, like on a home, about 20% is going to be land. So you got $20,000 peeled off of that $100,000 that's not going to be deductible at all.
Right.
Okay, just set that aside. Now you got $80,000. Now, what's that $80,000? Well, basically, you can break that down between three categories. There's the building itself. That's the shell of the building. Okay, that's depreciated at a rate of 3.6% per year. So 3.5%. If you put all to the building, which is what, by the way, most tax preparers do, is they just assume it's 20% land and 80% building. I see that literally 90% of the new clients that come to us and that have real estate, I see an 80-20 split. I see 80% to building and 20% to land and nothing to the other two categories. So that's 3.6% a year.
Or is it actually 4% now that Trump lowered it to 25 years?
No, he did not lower it.
He didn't lower it from 27.5 to 25?
No. It was originally lowered, and in the final bill, they did not lower it. In the final bill, they left it at 27.5.
Okay, so we're just at 3.6% then. 1 divided by 27.5.
Right. So 3.64% is your rate. So you take 3.64% of the 80,000, which is roughly what? $3,000. Okay, a little bit less than $3,000. However, you really bought two other categories of items. You bought the contents of the house. So you bought the cabinets and you bought the light fixtures and you bought the ceiling fans and you bought the window coverings and you bought the floor coverings and you bought the electrical that runs into the dishwasher and you bought the dishwasher. And so there's a lot of things you bought that's inside. And typically when we do a cost segregation, which is the function of an accountant to break this stuff out, we actually come up with somewhere between 10 and 20% and likely more on the 20% side. 20% of the whole property is really, we end up with what we call contents, and that's depreciated over 5 to 7 years, except now it's not, because beginning 2018, we have bonus depreciation. And so for a few years, we've got bonus depreciation, and bonus depreciation applies to used property now. That's a brand new change. Okay. It applies to used property, which means that we can buy a used property and take bonus depreciation and deduct it immediately. So on the contents, the other thing that we bought is we bought land improvements. We bought landscaping, we bought fencing, we bought outdoor lighting, we might bought a carport, and we segregate. Those get depreciated over 15 years. So about twice the rate, and actually a little bit more than twice the rate of the building. So we're going to depreciate those on average at about 8 to 10%. It's a decline balance thing. So you're going to get somewhere between that first year, 7,000 to 8,000, if it were all land improvements, right? It's not all land improvements. Let's say you had $10,000 of land improvements and you had, $20,000 of content, and then you have $50,000 of building. So we could do that math, I guess. It's 1,800 plus 20,000 plus 4,000. So it's about $25,000.
Yeah.
That's actually the number I'd come up with before. So
very good.
I have a pretty good sense of this. I hadn't run the math, but that's my sense of things, is that we'd end up at about 25%. So that very first year, we're going to get 25%. Now, after that, we're going to get, less. We're just going to get 3.64% on the 50,000, and we're going to get the 9 to 10% on the, 10,000. So it's going to go down quite a bit the second year because we get to deduct so much the first year. But the thing is one of the goals, I presume, Keith, for your listeners like our clients, is that you're continually buying new real estate because you're releveraging.
Right.
You're taking the money, you're buying new real estate, you're taking your tax benefits, you're buying new real estate. And when you do that, you're just continuing to add to that depreciation. Effectively, that's how we get to, as my book would say, it's tax-free wealth. As I was telling somebody the other day, we're not talking about tax-reduced wealth here. We're talking about tax-free wealth. And really, real estate is the one way to guarantee that you have tax-free wealth.
That is the magic of depreciation, which you described in your tax-free wealth book. This is a deduction that you can get, an amount that you do not have to pay taxes upon, which is what a deduction is, where you did not actually have to write a check as an expense out to somebody in order to get the deduction like you do with depreciation.
That's exactly right. In reality, the bank wrote the check, right? I mean, because
that's right.
The bank, spent $80,000 on that house. You spent $20,000. You wrote a check for the $20,000, which you're going to get back with depreciation, and yet you still get the deduction for the $100,000.
That's a great point. The biggest check that was written in that transaction was by the lien holder for a property that you control. That's astounding. So, well, yeah, Tom, we are looking at and we are interested in building our portfolios over time. We're all active real estate investors here. As we build our portfolio, we talk an awful lot about out-of-state real estate investing, a lot of turnkey real estate investing. And, why don't we talk about what portions of that trip are tax deductible for those that might want to go visit their property?
Good question. So here's the rule. The rule is that the purpose of the trip has to be investment related. It has to be related to your business, right? It has to be business related. And if the purpose of the trip is business related, then it's all deductible.
Now, this is whether someone currently owns a property or not. If they're just going to check out properties because they might buy them in a market, this applies to them too?
It does, Keith. If they are serious real estate investors. Now, not until they buy their first one. So until they buy their first one, that would be a startup expense because you're starting up a new business.
Okay.
But once you have your first rental property, now you are in the business of owning rental properties. So as you go to look for more rental properties, as long as you spend most of your time there looking for rental properties, right? I mean, if you go and you spend an hour looking for rental properties and 4.5 days at Disneyland in Southern California, that's not going to fly. Most of the time during the workday, you have to spend most of the time actually looking at real estate, actually doing real estate, meeting with your real estate agent, et cetera. And then that's what makes it deductible. But it's not just the trip. It's not just the airline or the mileage that's deductible, your food's deductible, your hotel's deductible. So all of your typically what we call ordinary necessary expenses of that trip for the purpose of doing business, all of that's going to be deductible. Now, if your spouse is also involved in your real estate, then theirs will be deductible as well. A little caution here, if I could. I hear a lot of people say, well, my children are owners of my real estate company, so therefore I get to take them and it's fully deductible. No, only if they're actively participating. Just because you're an owner doesn't make something deductible. You have to be actively participating in the activity in order for your portion to be deductible. So if you have older children and they go with you and they go on the real estate trips and they're actively involved and they're doing analysis, I'll tell you a great story. I was in London once and my driver, he had his 8-year-old son with him. And his 8-year-old was saying, oh, I know you. I've seen you on video and I've read your stuff. And I'm going, wow, this is some 8-year-old, right? So then his dad starts telling me about how his 8-year-old helped him, actually went with a realtor to look for investment property in Sicily. Actually, the realtor called him. He says, yeah, I'm going to have my son. Well, the realtor's thinking it's the 25-year-old son, right? No, it was his 8-year-old. And his 8-year-old actually went out. His 8-year-old came back, did the analysis, tell his dad. He said, Dad, it's not a good property. He said, you know what? We'd be better off renting than buying here, but the numbers work out better.
So he was actively involved in the business?
Absolutely, very actively involved. This 8-year-old, he was smart as a whip.
Yeah, so that's astounding. And now, does the same thing go for seminars as it does for going on a field trip and looking at property with making it deductible?
Yeah, it does. Now, seminars, I'd be a little careful about how you report this. This is where a good tax preparer is going to be so important to you, because if you report it on your tax return as seminars, the IRS is going to say, we don't like seminars. What this has to be is, in order to be deductible, it has to be qualified as continuing education. So you already have to be a real estate investor. This has to be your business. You really need to be a professional real estate investor. I think if you were a casual, if like you owned 1 or 2 properties and you bought them over a period of 3 or 4 years, I think you're going to have a hard time deducting seminars. However, if you are actively involved in your real estate business, you're actively looking, you're actively doing travel, you're actively getting education, and you're actually using that education and it's making you money. Remember, the rule for a deduction, first rule is it must be have a business purpose and be ordinary and necessary. So you've really got to show that, yes, this education is going to help me turn a profit. But second of all, education by itself is not enough. It's got to be a continuing education in your field of expertise. So if your field of expertise is real estate and you're getting more information about real estate and the seminars on real estate, then that seminar should be deductible as well as the travel, as long as you're not spending most of the time while you're there. You don't skip class and go see Disney World.
Right. So must one own a property first before they can deduct for seminars or not?
Yeah, same thing. So what it is though, it's called a startup cost, and startup costs are eventually deductible. Okay, so you keep track of all your startup costs. I actually urge people to keep a set of records of all of their expenses before they start, because once they start, a portion will be deductible, $5,000 the year that you start your business, and then you can amortize. That's like depreciation. You can amortize the rest of it over 15 years. So eventually you will get to deduct it. So keep track of it.
Yeah. Any other tips on documentation of these things when you want to deduct field trips and just general things on seminars?
I would just say document. Just make sure you're keeping a really good calendar. If you're driving, making sure you're keeping a good log for your car and have really good notes so that you can show. And frankly, what I would do is I would have a minutes in my shareholder meeting that said that, look, we've approved an expense to go to the X seminars during the year, and then you can show it even in your corporate record. So more documentation when it comes to education is way better than less documentation, and that's true for any deduction, because the IRS right now, I don't know if people realize that they're not very well trained right now, so they're not really good at the technical issues. So what they're doing is they're spending all of their time on the documentation issues, and they're only looking at documentation first. And if you don't have the documentation, it's not deductible. And by the way, a credit card statement is not a receipt. It does not qualify as documentation. So I don't care if it's an American Express statement, it does not qualify as documentation. You must have the actual receipt. So scan it in, get a scanning app, and scan in your receipts. Make sure that you keep those receipts because they're actually required by law, and you'll lose that case on audit.
Yeah, and that is such a great point, and it's such an inconvenient truth there on the documentation. And yeah, I use an app on my phone. It's called Receipts Plus, but there are a whole lot of them out there where you can just use your iPhone, your Android device to take a photo of a receipt if you had a paper one that was there, so you can convert it into electronic. Tom and I are going to come back and talk about where inflation and taxes intersect. You're listening to Get Rich Education. I'm your host, Keith Weinhold. For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com.
This is Rich Dad, Poor Dad author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Rich Dad tax advisor Tom Wheelwright about permanently reducing your taxes. You can learn more about Tom at wealthability.com. Tom, an interesting thing that I bring up with investors sometimes is you need to think more about inflation and how that applies to your investment life. So inflation and taxes intersect at an interesting place. Just looking at the stock investor, if a stock investor has a $100 stock, and that stock appreciates to $105, say they sell that stock a year later, 100 to 105, they have a $5 gain. Well, most of them think that they have a gain. Well, if the real rate of inflation, the diminished purchasing power of the dollar was 5%, well, then you have a wash. You actually have not increased your prosperity at all. You've only increased your dollars. But you know what? Actually, the investor that is aware of inflation, and if they did acknowledge that that was a wash, say we had 5% inflation and you had a 5% gain in your stock after a year, you know what? Your prosperity actually has still been diminished because you're going to get taxed on that $5 gain. So I guess my point is that taxation is not adjusted for inflation. And that's just one of so many reasons that you absolutely need to crush inflation if you're going to get ahead. Stocks don't do that very well. Real estate does. Any thoughts on the intersection of inflation and taxes?
A couple. First of all, you're absolutely right. So if your real inflation rate were 5% there, you would still be taxed approximately $1, right? 20% of that $5 gain. And so you'd really only have $104 where from a purchasing power standpoint, you have less purchasing power than what you had the year before, at $100. So absolutely that you got this inflation issue, and it's actually getting bigger. Now, a lot of the tax rates are adjusting for inflation now. So your tax rates do adjust for inflation. And unfortunately, so while pretty much everything now is inflation adjusted under the tax law, they've changed the inflation rate they use. So they used to use CPI. Now they use this modified CPI, which is lower. Okay. It's lower than CPI.
I'm not surprised.
If you thought CPI was bad, now remember CPI, where CPI came from, they adjusted that back in the 80s because the Federal Reserve, Chairman Alan Greenspan, he, in meeting with Congress and the president, he said, look, we're in trouble here because what's going on is that inflation is, because we're indexing our Social Security by inflation, we're going to run out of money with inflation. So what we have to do is we have to change how we calculate it. Now what they did in this tax law is they changed it again so that while your tax brackets do increase with inflation, they're really never going to keep up with real inflation. They're going to just keep up with this modified inflation adjustment. And so there's just a huge impact because not only are you paying tax on that, like in your example, but typically your tax rate's going up as well. So capital gains, no. But for your ordinary income, your actual income is going up. Now, and even for capital gains. So you might actually go from that 15% bracket to the 20% bracket on capital gains because of the appreciation, because all of your other income is going up with inflation. You may end up with in a 20% bracket instead of a 15% bracket. So not only are you paying tax on something that you didn't really make money, but you're actually paying an additional tax because of inflation.
Right. That's how you're losing ground just a little bit every year. Under this system, you might go into a progressively higher marginal income tax rate due to the way that they're applying that inflation number. That's
right. And that's my biggest complaint about IRAs and 401ks, frankly, is because people think, well, I'm going to be in a lower tax rate when I retire. Well, only if you retire poor, because otherwise inflation says, in 30 years, think about how much, your income's going to go up. And the tax brackets aren't going to go up proportionally. So you're going to be in a higher and higher tax bracket on the same amount of income.
Yeah. Inflation is actually difficult to determine. And yeah, Tom, I basically consider inflation as really just an opinion. It's really someone's opinion. It's difficult to nail that down to a hard number as to what inflation really is because everyone pays a different rate of inflation. If you drive a whole lot of miles, well, then gas and oil inflation is going to affect you more. If the price of beef goes up, that doesn't affect vegetarians. On and on. There are just so many things that go into inflation that it really just comes down to sort of a guess and an opinion.
Oh, that's awesome. Yep. I think you're absolutely right.
Yeah. But I think most people in the know agree that it is underreported. And, just look at who reports the CPI, the Consumer Price Index. That's reported by the Bureau of Labor Statistics. The Bureau of Labor Statistics, they're the same people responsible for reporting the unemployment rate at 4% right now, meaning 96% of people are employed. And I don't think anyone believes that either. So the CPI is manipulated and brought down to lower than it really is through things like substitution and weighting and so much more, and investors just don't consider inflation nearly enough.
I can't agree more. I just think that, people kind of ignore their thing. Well, inflation's been so low for so long, and it really has. It's been so much lower than it used to be that, people kind of ignore it. And, they buy into this idea that there's just not that much inflation, so I don't really have to worry about it. But the reality is Federal Reserve wants inflation, and inflation will always be there. And their biggest concern is deflation and hyperinflation, and they'd like to keep it in that 2 to 10% range. That's where they would like it.
Inflation sure isn't what it was back in the 1980s, but yeah, it's something that people just cannot discount. Well, it's really important for you to connect with a professional tax advisor that understands what real estate investors and other people need. So, Tom, tell our listeners how they can connect with you.
Come to wealthability.com. Wealthability.com. It's about your ability to create your own wealth. This is why I love being on your show, Keith, is because, that's your message. Your message, our message goes together. So wealthability.com, there's a button there you can click on for a consultation. We'd love to talk to you, see if there's any way we can help you.
Well, Tom, you've extended your record as the most recurrent guest in Get Rich Education history, and it's been great to have you back.
Thank you, Keith. Really appreciate it.
Yeah, what a valuable chat there with Tom, maybe our best ever. And how about the 5 facets, the 5 ways you're paid as a real estate investor that I'm always talking about, and how your total ROI is positively affected with the bonus depreciation that Tom explained. And inflation is virtually ever present in your life and in your investing life. And remember, inflation destroys both the value of your equity and inflation destroys the weight of your debt simultaneously. I love inflation, being a long-term fixed interest rate debtor. And what is the real rate of inflation? Well, there's a kind of quirky, wonky website out there, shadowstats.com. It says that right now the rate is 6 to 10% inflation if you consider calculating the CPI with how it used to be calculated back in the 1980s and the 1990s before it was manipulated so much. I actually have a hard time believing that it's that high right now on the consumer level, but then there's substantial asset inflation like we've had lately too. But I do have an easy time believing that the real rate is higher than the 2% rate that the government both currently targets and reports. You might check out shadowstats.com and draw your own conclusions. Thanks to wealthability.com's Tom Wheelwright. He has been such an awesome and frequent and longtime contributor here at GRE. And be sure to grab your investor report at getricheducation.com/Belize. If that appeals to you, let's meet there in person. I'll be coming to you with next week's show, where I'll be building your wealth from either in or near historic Philadelphia, Pennsylvania. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
If you want to retire in 5 years or less through real estate investing, then pay close attention as I'm about to share my proven recipe with you. This is Brad Sumrock, and I've taught thousands of people just like you how to replace their incomes, quit their jobs, or simply have more income and freedom than they ever thought possible. And we do this by investing in apartment buildings. After starting with no experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job after only 3 years of apartment investing. And I have hundreds of successful students that have had similar results. If you want to get out of the rat race or simply have more income and freedom in your life, then investing in apartment buildings might be the answer for you. Visit our website at bradsumrock.com to get more information about our upcoming training events. That's bradsumrock.com.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.